going to look at the claims against the assets. So in previous lessons, we explored the balance sheet. We looked at what an asset is, what a liability is, and what is included in the owner's equity section and how to find the capital amount. Now, if a business, for whatever reason, shuts down, whether it's unexpected or not, we need to figure out who has the rights to all of the assets. If I'm an owner, I can't just shut down my business and say, okay, all the assets are mine, and I'm just going to forget about those liabilities. No, unfortunately, that's not the way it goes, and we need to see who is entitled to what assets. So, in other terms, claims against the assets refer to the rights that different parties have on companies' resources. So, we are looking at two different categories. Number one being claims by creditors, so our liabilities. Think about your accounts payable section, and our claims by the owners or capital in our equity section. So, together, those two make up who is deserving of what asset and for how much money. So going back to the balance sheet, when we ordered the assets in our list, we ordered them in terms of liquidity. Okay. So if a business owes money, well, first they're going to go into their bank account and see how much money is in their account, and they are going to use that money to pay off the debt. Okay. Now, oftentimes there's not enough money in a bank account to cover all of the debt and all of the liabilities. So then businesses have to start converting these other assets into cash. So we call this liquidating. Okay, so to liquidate the assets means selling things off to make money off of it. After the creditors have been paid, so when all of the liabilities are paid off, then the owner is the last one that can take any remaining profit that is made. So again, the liabilities need to be paid off first. So again, as a review, liabilities are obligations or debts the company owes to outside parties. And this must be settled in the future through the transfer of assets, provision of services, or other economic benefits. We previously talked about current versus long term. So a current liability is usually due within 1 year or the company's operating cycle, whichever is longer. So we talked about the fiscal period. Oftentimes that is a year, but if it is not, if it is shorter or longer, a current liability would be either in that 1 year or the company's operating cycle and the longer of the two. Examples include accounts payable. These are usually accounts owed within 30 days, short-term loans, accrued expenses. So if we're thinking about wages that we need to pay, our taxes, that would be a current liability, and unearned revenue. Unearned revenue is money that was received before delivering the service or the good. So it's money that we have in our account, but it's a liability because we still have to provide the good or service. Long-term liabilities, on the other hand, are due beyond the 1 year or the operating cycle. These are bigger amounts. So if we look at mortgages, bonds, or long-term loans, those would be in the long-term liability sector. Current assets, again, are smaller assets, not always smaller, but assets that can be converted into cash within a year. So cash, right? Any money that's in the bank, accounts receivable, usually those accounts are paid within 30 days, or supplies. We can quickly convert that into cash, whereas fixed assets are more long-term, and they usually take longer than a year to sell, and they are usually harder to sell. So land, if we look at factory plants, equipment, building, big ticket items, these are fixed assets. So when we are closing a business, liabilities need to be sorted out first because these creditors have legal rights to be paid back before, as an owner, you can go in and take the remaining profit. The liabilities represent claims creditors have on the company's assets. If a company liquidates, so if they're selling off their assets, creditors are paid first from the available assets. Only after all the liabilities are settled can the owner take the rest of the value. Okay. It's very important to understand that hierarchy. We're not, as an owner going in and saying, I'm going to take what I want. No, the liabilities have to be paid first, always. If a business is closed down, the assets still belong to the owners and the creditors, but the claims of the creditors are settled first. So this means that the owner has to accept any losses that might occur from selling off any assets. So even if an owner walks away and they don't have any profit, they have to accept their losses. Okay. On the other hand, an owner gets to benefit from the profits that are remaining and that occur from selling off any additional assets. So basically, the owner gets whatever is left over at the end. Now, going back to the balance sheet, we looked at how the balance sheet is formatted and how we have the assets on one side, the liabilities and owner's equity on the other side. And we looked at the order. So we have our current assets first, we have our current liabilities first, then we have our more long-term items listed further down the list. And this is why, because if we are closing down a business, we need to see, okay, what are my most liquid assets? What liabilities need to be paid off first? At the end of the day, we have to remember that accounting equation. So assets equals our liabilities plus our owner's equity. And again, our liabilities are the creditors' claims. So they have to receive their money first. Now, what does this mean as far as financial stability and risk? Well, if you have high liabilities or high debt levels, so if you have a lot of debt, that could indicate some financial risk. Okay. In this case, creditors might find that your business is too risky to give loans out to. And so, because creditors expect timely payments. So if you are not able to meet those timely payments, you are becoming a risk to them. This can lead to default or bankruptcy in a business. So when we are looking at a balance sheet, it's important to look at how many assets we have compared to the liabilities. Yes, businesses are going to have liabilities. That is just the way it goes. However, you want a balanced mix. You don't want to have too many liabilities and only a couple of assets. You want it to be fairly balanced so that you are less risky as a business, you have more stability, and you're able to grow. You have more opportunities for sustainable growth. Now, we already touched on liquidity, but solvency is the ability to meet long term obligations and continue operations. So, solvency is important. Now, if a creditor sees that you are more risky, if they're looking at your financial information and they see that it might be more of a risk for them to lend you money or have that type of relationship, then they may impose covenants or restrictions to protect their claims. Companies with strong creditor claims may face limitations on borrowing or on operations, which can be a risk for a business as well. Claims against assets represent the legal rights creditors and owners have on a company's resources. So, therefore, differentiating between current and long term liabilities helps assess the timing of these claims. And understanding these claims and their representation in financial statements is vital for evaluating a company's financial health and stability. Okay, so just remember your key takeaways here are: one, if a business shuts down, the liabilities need to be paid off first. Our creditors need their payment. And once all of our liabilities have been resolved, then the owner gets whatever is left over. Okay, thank you.